Debate Eric Johnston, head of equity derivatives and cross-asset at Cantor Fitzgerald, and Phil Camporeale, portfolio manager at JPMorgan Asset Management. Guys, let's start the initial case relatively briefly, if we can, and then we can dig into it. Eric, your view.
Sure. So we think there's more downside to go from here, and it's for a few different reasons. So number one, the Fed has ballooned its balance sheet. It has suppressed real yields. It has really wanted higher multiples and wanted speculation at higher asset prices. That's now about to go in reverse. And we've seen there's been a very high correlation between the Fed balance sheet and PE multiples, and we expect the balance sheet to contract. The second thing is we think earnings estimates have peaked. This is a big deal. Last year, earnings estimates were up by 26% from where they started the year to the end of the year. Now you fast forward to this year, we think they've peaked. Economic data is softening, and this most recent sell-off in equities could even further impact the economic data. And then the third point would be positioning. Investors, for the most part, have not adjusted to this new world, this new Fed world, this new peak estimate world, and we think they still need to adjust. The individual investor has been adding dollars to this market for the past year. They have not turned seller yet, and we think that's going to be a big overhang along with other investor types.
Phil, why do you disagree with Eric?
Yeah, so good to be here, Will. Thanks for having me. So we are still very confident in our view in stocks in a multi-asset portfolio and being overweight stocks in a multi-asset portfolio. And here's the reason why. And again, it goes back to the Fed. And I think some of those concerns that Eric mentioned are warranted. But now, which is very different from last year, the market is hearing the Fed loud and clear. The transmission mechanism is open. So what do I mean by that? So ever since the Fed made their pivot in December, what we've seen this year has been a reduction in the most growthy names, an increase in rates, and an increase in real rates. And Will, I think, one of the things in my career that I've seen is when interest rates go up and stocks go down, people freak out. Right? I think that paralyzes people. But from here, what we would expect is no news is good news with the Fed. It's hard for them to get even more hawkish than they are now with how much is priced into the market. And then you settle into an environment where the VIX, so equity volatility and rate volatility, settle down. And if that were to happen, that creates a really good environment for taking risk. And most importantly, even though the Fed wants to establish credibility on inflation, they do not want to do it at the expense of growth, right? So if you go back in history, 11 out of 12 tightening cycles since 1950, Will, the market has been higher by an average of 9%. So as Mark Twain said, history doesn't repeat itself, but it often rhymes. I think the Fed is in a position where no news is good news. They can't really get any more hawkish unless they're wrong on inflation. And that creates a good fundamental backdrop for taking risk.
It seems like the biggest point of disagreement, Eric and Phil, is on how the market is going to react to the Fed tightening. Eric, do you not think that this market and economy can handle a few interest rate increases, slightly higher rates?
I think it goes beyond the rate hikes. I think the issue is that the balance sheet, potentially as soon as 4 or 5 months from now, it's not just going to stop growing. It's going to start to decline. And if you look at the last 12 years, the balance sheet has gone sideways or up in every year except for 2018. It just so happened in 2018, equities sold off at 1.20%. And so investors right now are used to the Fed just pumping money. That's been for the last 12 years. And that's about to go into reverse. And this is not something that's going to be the Fed hawkish for 2 months or 3 months. Inflation is going to be well above their target all year long. So this narrative and what the Fed is actually going to do, the hawkishness, is going to be persistent throughout the year. So it may just be beginning, people may be aware of it, but they haven't adjusted their mindset and they haven't adjusted their portfolio to this new reality.
Yes, Sarah, and I think that's where we would politely disagree, right, is the fact that we don't believe that the Fed is going to get more hawkish than here. They do have a core inflation rate forecast for 2022 in totality at about 2.8 and a growth forecast at 4%. So in that environment, I think that just keeps them on track. And the point that Eric brought up about 2018, the Fed were deer in the headlights. When the market dropped like that, what did they do in January? They said, we're going to pause. And the other thing is just operating from a position of strength. Their balance sheet, as Eric pointed out, has ballooned to $8 trillion. They would have to do $4 trillion of quantitative tightening just to get the balance sheet to where it was in the last cycle, where stocks did really, really well. So I think the point of contention is really around our fundamental story, which remains strong, and the Fed's ability to gradually move. If we're wrong on inflation, we got the wrong view. Okay, and that's really what it comes down to. Our view is that inflation comes down and settles between 2.5 and 3 by the end of this year, which creates a lot less urgency and hawkish kind of chaos from what we're seeing right now.
I would just interject on that point is that, I think right now, unlike prior periods, I think the Fed would actually be okay with stock prices selling off, because one of the big contributors to what we've seen around inflation has been the wealth effect, where wealth has grown last year by historic proportions, and that has allowed consumers to pay higher prices. To the extent that asset prices come down, whether it be crypto or whether it be the stock market, that will actually be one of the better things for the inflation picture. And so I don't think it's the case where, as stock prices go down, that the Fed will make adjustments. I think the Fed will make adjustments when inflation gets closer to their 2% target, which I just think is a long way off.
Eric, very quickly, what are we talking about? A further 5% down for stocks, or more than that?
So in these situations, stocks always overshoot. And so what I would tell you is that I think going to 4,000 or 4,100 is very, very real and very, very realistic. I would also tell you that there's a high likelihood of an overshoot, because when you get into these momentum type situations, where once you get down to that level, you do tend to have overshoots. So it'll probably end up below there.
What about you, Phil? What's your target on the upside?
Yeah, so we believe stocks are going to be higher than there, which is why we're overweight stocks versus bonds here, Sarah. But the key here is spreading and diversifying the risk. We're talking about the U.S. equity market here, and I think that's fine. European equities are part of our overweight, but also we've been very pleased, Sarah, with how emerging markets have hung in this month, because guess what? China's the only central bank that's not worried about inflation, and they're easing policy. So I think spreading the risk to beyond just U.S. And Sarah, I've been on this show a bunch of times talking about a U.S. overweight. It looks a little bit more diversified now. And within fixed income, just own credit over ag bonds here.
It has been interesting to see emerging markets outperform. Gentlemen, good debate. Very, very civil. Good points all around. Eric Johnston, Phil Camporeale.
We're all friends, Sarah. Thank you.